This is Rod Kusin, Spooman for Risk. The videos that we're about to be producing are going to be placed on YouTube primarily for the benefit of our subscribers. And therefore, if you're not familiar with our system, some of this information that you may be viewing could be a little over your head. And that's because we're designing it primarily for those who are already familiar with our system. So, that having been said, this particular video, I should say, is going to start us off with an approach that we may choose to use in order to set up for the day. How are you going to approach the day? What's your plan? You should always have some sort of a plan as to how you're going to approach the day's trading. Now, one way you can do this, and by the way, there's no right or wrong to any of this, but one way you can do that is through the zones. Now, we have on this screen a series of 8 different zones. What you may choose to do is to pick one of these zones based upon the activity during the latter part of the afternoon of the previous day into the overnight market. Let's take a look at an example of this. Supposing we just grab this 500 tick bar. Now here's a 500 tick bar ES chart with a zone wrapped around it. Question number 1. How well does the market move in relationship to this zone during the latter part of the afternoon of the previous day on into the overnight market? As you observe this, ask yourself a few questions. How close to both the upper and the lower zone did the SPOOs move? Did they stay within the zone or did they go way beyond it? If they've gone way beyond the zone, you probably need a larger tick bar interval. Okay? This never got back into the zone, and of course there was a pretty significant sell-off during the latter part of that afternoon. And if you go back here earlier during the day, it still moved pretty much beyond the zone, and so there was money left on the table if you used this. All right? We want to try to get as close to the zones as we can in terms of the volatility, highs being close to the top of the zone, lows being close to the bottom zone, the inner zone, of course. So maybe we need a larger zone. We've doubled the zone here, and we're looking at an 1100 tick bar. And let's go back to the beginning. Here's the afternoon, and you notice how down here at the bottom of the zone, barely get into it here and here and here and here, but we don't see much of a retracement. Well, sometimes we won't. We had a fairly significant sell-off here, and there wasn't any retracement. That's understandable. Okay? But now look at the overnight market, way beyond the zone here. Went way beyond the zone. Rallied up, came back, hit the zone, rallied up here, just beyond the zone, so we're trading in here, into the open. So this looks pretty good. Now, again, there's no right or wrong answer to this question of what zone you're going to choose, but here's the idea. Now watch this. The trading range is between the two inner zones. That's your trading range. So the difference between the upper band and the lower band, take that difference, all right, roughly 84 to 77, so approximately 7 points. And if you scan through this, it's going to change a little bit. Here's only about 5 points. Here it's about 4 points. There's about a little more than 4 points. So this zone of 1100 tick bars represents a potential 4-point move from the upper to the lower inner bands. Now, how can you put this to use? One way is to set up the strategy, first of all, to recognize this zone. Secondly, based upon the number of points between the upper and the lower, you could use this as a profit target. Another way is to simply wait until the SPOOs get to the opposite band and look for a group reversal to exit the trade. Another approach you could take is to add a stochastic. Use the stochastic in conjunction with the zone, as well as group reversals, to determine when you're going to both enter the trade and exit it. So let's take a quick look at how this might work. So let's bring ourselves to the open, right in here, and we're not into the lower band, but our first trade is going to be long. Why? Because it's into the lower band. It's really that simple. That's what we're expecting. It's in the lower band. Hopefully we'll get some sort of a rebound. Now, we're not taking anything else into consideration, but just the fact that it's in the lower band, we've got a stochastic that's turning. So here, our first opportunity is shortly after the open. The stochastic is turning. We look to go long. That trade doesn't succeed. The next trade, however, it's into the band, stochastic turns. Now we're long, and what are we doing? Depending upon, or really not, it doesn't really matter where our entry is, but we could set up the strategy to exit the trade after a 4-point move. Or the other way to do it is to wait until we are at the upper band and the stochastic is beginning to turn, or at least it's into its upper zone. Nice way to trade. There's a nice 4-point move there. Entry at around 83. Up here, right in here, 87 at the low of that bar. Once again, 83, 87, 4-point move. Supposing now you're looking to go short. You attempt it, it fails. You attempt it again, it fails. Now you have plenty of time to tighten the stop here. Here's another example. It fails. But finally, there you are. You're getting in at the high at around, say, 89, and you run it all the way down to around 86. So there's about a 3 to 4 point move there on the short. Now notice the stochastic turns. You're not quite to the lower band, but the stochastic is turning, and you've got at least your profit target in this particular case. Now in our next video, we're going to discuss how to set this up in the strategy, and we'll show you how that works. So let's go on to our next video.